Hello friends, in today's video I will be talking about the new tax on long-term capital gains on sale of equities which has been imposed by the budget of 2018. Now before I start with, I would like to talk about what is the long-term capital gain and what is a short-term capital gain in cases of equities. So in case of equity, if you hold any equity stocks or shares for a period of more than 1 year, it will be a long-term capital gain, and the gain which you receive from the sale of such stocks after holding it for more than 1 year, it is long-term capital gain. If not held for more than 1 year or 12 months, it is a short-term capital gain. So the budget of 2018, it proposes to change how long-term capital gains on equity shares and units of equity oriented mutual funds are taxed in an individual's hand. The budget, it proposes a long-term capital gain tax of 10% on sale of equities if the gain from the sale of the equity exceeds rupees 1 lakh without allowing benefit of indexation. So only if your gain is more than rupees 1 lakh, then a 10% long-term capital gain tax would be imposed. However, all gains till 31st January 2018 will be grandfathered, and all short-term capital gains will be taxed as it was previously. So the budget states that the all gains which you incur up to 31st of March, you will not have to pay any taxes on such long-term capital gains. So this tax is not a retrospective tax, which is a good thing. So all gains till 31st of Jan, you will not have to pay any taxes. So now this budget is of 2018, so it will be effective from 1st of April 2018. Now the confusion regarding the dates, I will try to clear all your confusion by way of examples later in this video. Now what do you need to know regarding this tax? No capital gain on long-term capital gains before the date of implementation of provisions of the budgets. So there is no capital gain tax on this any long-term capital gains before the date of implementation of the provisions of the budget 2018. Thus from 1st of April 2018, LTCG tax would be imposed. Now tax has to be paid on gains from 1st of Feb 2018. So all gains from 1st of Feb you have to pay tax. There is no change in short-term capital gains and securities transaction tax. So what type of assets are included in this new provision? Stocks and shares, equity mutual funds, equity linked savings schemes, equity savings funds, balanced funds, arbitrage funds. ULIPs, there is not clearly maintained in the budgetary provisions, but in all possibilities outside the provision of this tax. So if you look at the provision of the LTCG, so all gains till 31st of March 2018, short-term capital gain, it was levied at 15%, long-term capital gain, there was no such long-term capital gain, but post 31st of January 2018, short-term capital gain would be 15% as it was prior to 31st of January. Long-term capital gain would be 10% if the long-term capital gain is more than 1 lakh rupees. Now, cost of acquisitions of the shares at equity mutual fund units which are bought prior to 1st of February. So if you have any equity shares which you had bought prior to 1st of February 2018, the cost of acquisition of such shares or equity mutual funds only will be higher of first actual cost of acquisition of the asset, that is the purchase price into the number of units which you have purchased, or lower of these two, lower of the fair market value of this asset, that is the price of the share or the NAV as on 31st of January 2018, or the sale value which you have received or accrued when the share of the unit was sold. So this formula is applicable only for those shares or equity funds which have been bought prior to 1st of February 2018. Now this will be clear by my following example, this example, and we have some more examples which I will explain you in detail. So if you sell equity shares which are listed on the stock exchange within 12 months of buying them, then you will earn a short-term capital gain. Short-term capital gain will be sale price less expenses on sale less purchase price. Or you may incur a short-term capital gain, short capital loss when you sell them at a price lower than that you bought for. So this is obvious. And if you are selling it after 12 months of purchase, then they are long-term. So suppose you have 1,000 units of any share and you sell such shares after 1st of April 2018. So the date of purchase of those shares was 20th January 2015 and the date of the sale was 20th of April 2018. So you sell them on 20th of April 2018, so it's more than 12 months. In pre-budget scenario, the purchase price was 100 rupees, sale price 180, market value on 31st of January 2018 was 140. Pre-budget scenario, this is not applicable. Market value you do not have to see. Cost of acquisition is 100 rupees, sale value is 1,80,000, capital gain is 80,000, there is no LTCG. But post-budget, you have to see this sale price and the market value first. Lower of these two, lower of the sale price and the market value, you have to consider lower is 140 rupees as per the formula. So I am moving as per this formula. So lower of fair market value and the sale value received, that is 140 rupees. Higher of the purchase price and the lower of these two, which is 140. So cost of acquisition of such shares would be 140 rupees. So higher of actual cost of acquisition is 100 rupees, or lower of fair market value or sale value received, which is 140 rupees. So the higher of both the two would be 140 rupees will be your cost of acquisition. You sell it as 180, 1,80,000. Capital gain is 40,000 here. You have to see the difference between pre-budget and post-budget. Then you will understand it better. So 40,000 is your capital gain. Now tax. There will be no capital gain tax. Why? Because it is less than rupees 1 lakh. So for up to 1 lakhs, you do not have to pay any long-term capital gain tax even post-budget 2018. So this will benefit the short, very small investors. The second one, what happens is the purchase. So it's the same. You have 1,000 units. You sell it on 20th of April 2018. You purchase it on 20th of Jan 2015. Now the purchase price is 100 rupees in both cases. Sale price is 240. Market value on 31st of Jan is 250. Lower of these two is the sale price 240 rupees and higher of both will be the sale price again 240 rupees. So cost of acquisition in post budget would be 240 rupees. Your capital gain will be 0. Sale value minus cost of acquisition is also the sale value only for these shares, because it is the lower of the sale price and market value is sale value only. This is 240 rupees and higher of the purchase price and the lower of these two will be again 240. So 240 minus 240, 0 will be the capital gain. Whereas in case of the pre-budget scenario, you would have a capital gain because sale value will be 240, cost of acquisition 1 lakh, 1,40,000 would be your capital gain. So this is the difference. Now the most important point is, if your sale price was 250 in post-budget scenario, market value was 230, lower of these two 230, higher of these two would be 230. So cost of acquisition would be 230, sale value would be 2,50,000, your capital gain would be 2 lakhs and long-term capital gain would be 10% of 1 lakh. Why? Up to 1 lakh there is no capital gain. So the excess of 1 lakh, 2 lakh minus 1 lakh, which is 1 lakh, would be the capital gain. Capital gain tax would be rupees 10,000. So I hope with these examples you are able to understand the working of this capital gain tax. Now what's this tax expected? It was expected because tax on gains from stocks, where the long-term capital gains tax is imposed in various markets, which developed and emerging markets. So what is the effect of this tax? If your gains are less than rupees 1 lakh, there is no impact. If you are planning to invest in equities, then you have to consider the tax element while you are considering the returns from such. Now, if you are planning to sell the stocks, then you can do so before 31st of March 2018. Then you will not be affected by this tax. Thank you. If you require any further information, you can always write down in the comment section below. Thank you.